Hey, good morning once again, options traders, and happy Friday to everyone. I got an interesting email from one of our traders asking, how do you figure out which interest rate the market is using to price an option? And it's a question that doesn't come up a lot, but one might be for figuring out if a call option is a viable candidate for early exercise. So there are times that you might need to back into figuring out which interest rate the market is using. And we can do that by figuring out the difference between the call and the put. There's a tiny bit of math, but nothing that I'm sure everybody out there can handle, but I'll step you through it. But for those times that you're trying to figure out which interest rate the market is using, here's how you're going to do it. And as always, before we get started, please be sure to click like and subscribe. It's greatly appreciated and helps so much to promote the channel. So how do we figure this out? Well, we have to go back to our synthetics formula. And for those who may not be familiar with it, I do have other videos in here under put call parity and under synthetics. So you can certainly search for that and find those videos. So one of the basic forms of the put call parity equation, which is what we use to figure out our synthetic option positions, is stock plus put plus a short call or minus a call equals the present value of the exercise price. Now that's a mouthful, a fancy way of saying a bond. So you can think of this right side of the equation as a T-bill or a bank CD. And what we're saying is, how much would you need to deposit today so that when we get to expiration, that the amount of cash we would have would equal the exercise price. So for example, let's say that the interest rate is 5% and we have a 1-year $100 call option. Well, the 100 is the exercise price. So we take 100 divided by 1 plus the interest rate is 1.05, and that gives us 95.24. So what this means is that if you deposited $95.24 into a bank paying 5% interest, in 1 year, you would have exactly 100 bucks, enough to pay for the exercise price. Now, of course, if you had a 6-month option, you would need to divide 5% by 2. If it's a 3-month option, you would take 5% divided by 4, and so on. So you could just simply scale that interest rate according to your expiration date of your option. But right here is the present value of the exercise price. So what we're going to do is we're going to flip this equation around so that we get the call and the put on the right-hand side. And that's how we're going to figure it out. We're going to look at the difference between the call and the put. And to do that, we need to subtract the present value of the exercise price, bring that over. So when we're all done, we get this. We have stock minus the bond, let's call it, or our bank CD, equals the difference between the call and the put. So using the previous example, if we have the stock at 100 and the strike at 100, the present value of that exercise price is 95.24, that would equal the difference between the call and the put. So this difference right here is 476. We would see a difference of 476 between the call and the put. So for example, let's go over to a pricing model. And for the first example, we're going to say the stock is 100, the strike is 100, 360 days to expiration, 20% volatility, and interest rates of 5%. So notice the calculator is telling us the call would be worth about 1033 and the put at 557. Well, if we subtract these, we take the call price minus the put price, we get a difference of 476. Now, this is the present value of that 5% interest. So in other words, you're saying that if you deposited $100 into a bank at 5% interest, you would earn $5, but that would be in 1 year. You're not earning $5 today. So what's the value of that $5 today? Well, we have to take $5 divided by 1 plus the interest rate, or 1.05. And that's giving us 476. That's where that difference is coming from. So the way that we can figure this out by using put call parity is to do a little tweak to our equation. We can say that the difference between the call and the put price, and set it equal to the difference between the stock and the exercise price. So in the previous slide, I said this should be the stock minus the present value of the exercise price, and this formula would exactly balance. Well, we don't know how to figure out the present value of the exercise price because we don't know which interest rate the market is using. That's the whole problem. But again, we can back into it. And we're doing it just by forgetting about the interest here. So we've got call minus put equals S minus E. So let's take the stock minus the exercise price, and that's going to give us 100 minus 100. The difference of the call and the put, again, we found out is 476. So now we're coming up with 476, that's the left-hand side, equals 0. Well, obviously that's not true. Why is there a discrepancy? Because we didn't account for the interest rate up here. If we did account for it, we would come up with exactly 0. So this is a way that we can back into it and say that the reason for this discrepancy is because we didn't account for the interest rate. But again, that's the thing that was unknown. So we know that the market is using 476 for the present value of the interest rate. Now, does it matter which stock price or strike that we have or time to expiration? Not at all, or even volatility. That all comes out in the pricing of the options. So for example, what if we have the stock at 105? We'll leave the strike at 100. We'll leave everything else the same. What's the difference in the call and the put now? We've got 1373 minus 397. That's a difference of 976. And notice that that's $5 more than the 476 answer we came up with. And that's because this call now has $5 of intrinsic value. So let's go back to our formula. The difference between the call and the put, we'll set it equal to the stock and the exercise price. We know that the difference in the call and the put is 976. We set it equal to 105, that's the stock price, minus the exercise price of 100. 105 minus 100. So we come up with 976 equals 5, which of course is not true. Why is there a discrepancy? Because we didn't account for the interest. How much of a discrepancy is there here? Difference between 976 and 5 is 476. So you see, it turns out it doesn't really matter which numbers we have. We just throw it into this formula, call minus put, set it equal to S minus E. We know these numbers in the markets. We can find the call and the put prices. We know the stock price. We know the exercise price. We know that they're not going to exactly equal. And that difference is due to the interest. Now we do have another slight discrepancy here to contend with, and we've come up with a difference of 476. And on one hand, you could say, well, 476 is the interest divided by the exercise price of 100 is an interest rate of 476. But as we're finding out, it's really 5%. So we would have to figure out a way to find the future value of it. Now, in most cases, you're going to be able to probably use the 476 and it's going to get you close enough. But what if you wanted to figure it out exactly? Well, here's another step you would have to do. You're taking the interest rate, the true interest rate of the market, divided by 1 plus that rate, and setting it equal to this implied rate that we've found out so far, 0.0476. So let's multiply both sides by 1 plus r. That's going to swing this over to this side. We get r equals 0.0476 times 1 plus r. So most of you will remember when you get this, you have to multiply this 0.0476 by 1, and then you have to add it to 0.0476 times r. So let's do that. We've got r equals 0.0476. That's multiplying these two terms. And we add it to 0.0476 times r. That's just multiplying those two together. What do we have now? Let's get all of our r's together. We have an r over here. That is assumed to be a 1. If there's not a number in front of it, it's just a full r. It's 1r. We'll subtract off 0.0476r. All right, so that's going to be our new left-hand side, equals 0.0476. We take 1r minus 0.0476r, we get 0.9524r equals the right-hand side here, 0.0476. And if we take 0.0476 divided by 0.9524, we get a rate of 0.05 or 5%. So once again, this question doesn't come up a lot, but when it does, it can be an important deciding factor. And so a lot of times traders wonder, is there a way to figure out the interest rate that the market is using? And the answer is yes. We just need to know our put-call parity formula for synthetics, and we just simply look at the difference in the call and the put strikes, and we can back into the rate from there. And so for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a brand new candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.